Yes, Trump just confirmed it. But here's the truth. If you've seen posts shouting about a $4,000 Social Security bonus, it's not what it sounds like. There's no special one-time payout, no secret program waiting to drop money into your account. What is real are the official 2025 numbers and the decisions you control. When you claim, how long you work, how you handle taxes and Medicare, and whether you act before key dates this fall. In 2025, the maximum retirement benefit at full retirement age is $4,018 a month. If you wait until age 70, it rises to $5,108. Those are the ceilings for this year. Over the next 12 minutes, I'm going to cut through the rumors, give you the exact payment dates heading into September, show you how Medicare and taxes change what lands in your bank account, explain the earnings limits, the wage cap, and the new overpayment rules, and then walk you through simple steps to make sure you're not leaving money on the table. Most people never get this spelled out clearly. By the end of this video, you will. Let's level set the bonus myth. Social Security doesn't do surprise giveaways. Your check is determined by a formula that looks at your highest 35 years of earnings, adjusts them for wage growth, and then applies reductions or increases based on the age you claim. Two forces push your benefit higher over time. The first is the annual cost of living adjustment, the COLA, designed to help your benefit keep pace with inflation. In January 2025, benefits rose 2.5%. The average retirement check increased from roughly $1,927 a month to around $1,976, about $49 more each month, nearly $600 more for the year. The second force is delayed retirement credits. For each year you wait after your full retirement age, your monthly benefit grows by roughly 8%, up to age 70. When you stack those two forces together, the annual COLA plus the power of waiting, you get to those big monthly numbers you see online. Not a bonus, not a loophole, just the math of the system working in your favor if you plan for it. To make this practical, let me introduce three people who could be your neighbors. Robert Chen is 69. He worked in engineering for 40 years, often earning near the taxable wage cap. Robert resisted the temptation to claim early at 62. He kept a flexible consulting schedule, managed his income, and watched how each year he delayed after full retirement age boosted his eventual check. This fall, as he turns 70, Robert's benefit will be just over $5,000 per month, more than $60,000 a year, adjusted for inflation, for as long as he lives. That's not hype. That's a lifetime of steady earnings, plus the 8% per year boost for waiting. Now meet Sarah Martinez, 67. Sarah is a devoted grandmother who worked part-time for many years. At 62, she filed immediately because getting a check now felt safer than waiting. Like so many, she didn't realize early claiming permanently reduces your monthly benefit, or that Social Security averages your highest 35 years. With several low-earning and zero-earning years in the calculation, her benefit came in much lower than it could have been. Over time, that decision has cost her more than $15,000 she might otherwise have received. Today, her check is around $2,000 a month, less than half of Robert's. She's not alone. This is one of the most common, costly misunderstandings. Then there's Maria Rodriguez, 71. Maria nearly followed Sarah's path, but two key pieces of information changed everything. First, she learned about spousal and survivor rules that affected her household strategy. Second, when her income dropped after her husband passed away, her Medicare premium jumped due to prior higher income tax returns. A neighbor told her about Form SSA 44, the request to reduce IRMAA surcharges after a life-changing event like retirement or the death of a spouse. Maria filed the form with documentation. The surcharge came off, and over time she avoided roughly $12,000 in extra costs. One piece of paper. One afternoon at the kitchen table. Years of savings. Now let's talk about the numbers you need to know for 2025. If you claim at 62, the earliest age, the maximum monthly benefit this year is $2,831. If you claim at your full retirement age, between 66 and 67 depending on your birth year, the maximum is $4,018. If you wait until 70, the ceiling is $5,108 a month. Those are the top numbers. Most people receive less because the calculation is based on real earnings. But even if you're not near the cap, a single strong year of earnings at the end of your career can replace a low year in your 35-year average and increase your check permanently. That's a lever many people still have, even late in the game. If you're working while receiving benefits, be mindful of the retirement earnings test. Before full retirement age, you can earn up to $23,400 in 2025 without any reduction. Earn above that, and Social Security will withhold $1 in benefits for every $2 you earn over the limit. In the calendar year you reach your full retirement age, the earnings threshold jumps to $62,160, and the reduction becomes $1 withheld for every $3 above the limit, and only for earnings before the month you hit FRA. After you reach full retirement age, the earnings test disappears entirely. You can earn as much as you want without losing benefits. Here's the nuance most people miss. Withheld benefits due to the earnings test aren't necessarily gone forever. When you reach full retirement age, your monthly benefit is recalculated to account for the months when you didn't receive a check, effectively crediting you back over time. So yes, the earnings test can pinch cash flow now, but it doesn't always mean you lose those dollars for good. Let's cover the payroll taxes that fund the system, because they matter for both your paycheck today and your benefit tomorrow. The taxable wage base for 2025, the maximum earnings subject to Social Security tax, is $176,100. You and your employer each pay 6.2% of your wages up to that cap. If you're self-employed, you pay the combined 12.4%. Why does this matter late in your career? Because if your current year earnings up to that cap are higher than a lower earning year in your past, this year can replace that old year in your 35-year average and lift your benefit for life. Even 1 year can make a meaningful difference. Now let's get you the payment dates you can pencil on the kitchen calendar right now. For September 2025, supplemental security income will be paid early on Friday, August 29th, because the first of the month falls on Labor Day. That's SSI for September, arriving before the holiday weekend. Social Security retirement, disability, and survivor benefits follow the standard Wednesday schedule. If you started benefits before May 1997, or you receive both Social Security and SSI, your deposit will hit on Wednesday, September 3rd. If your birthday falls on the 1st through the 10th, you'll be paid Wednesday, September 10th. Birthdays from the 11th through the 20th pay on Wednesday, September 17th. Birthdays from the 21st through the 31st pay on Wednesday, September 24th. Later in the year, there are 2 double SSI payments, Thursday, October 31st and Wednesday, December 31st. Those double months aren't extra money. They simply shift the normal first of the month SSI into the prior business day because of weekends and holidays. Knowing these dates helps with cash flow planning, avoiding overdrafts, and keeping the stress down. Now, the part that changes your net deposit, Medicare. For most retirees, Medicare Part B premiums are deducted directly from Social Security. In 2025, Part B is $185 per month, and the annual deductible is $257. If your income is higher, you may see IRMA surcharges applied to Part B and Part D. The first IRMA bracket starts at $106,000 of modified adjusted gross income for single filers and $212,000 for joint filers. Part D, drug plan surcharges start around $13.70 per month and rise by bracket. If those surcharges are showing up because your last tax return reflects older, higher income, and your income has since dropped due to retirement, divorce, or the death of a spouse, you can ask Social Security to use your current lower income instead. That's what Form SSA 44 is for. Print it, fill it out carefully, attach your proof, and submit it. For many households, that one action saves hundreds of dollars per year. While we're on net versus gross, let's talk taxes on your benefits. At the federal level, up to 85% of your Social Security can be taxable depending on your combined income, which includes your adjusted gross income, any non-taxable interest, and half of your Social Security benefits. The thresholds haven't budged in decades: $25,000 for single filers and $32,000 for married couples filing jointly. Once your combined income crosses those lines, a portion of your benefit becomes taxable. States vary widely. Some don't tax Social Security at all, some tax it fully, and some offer partial exemptions that phase out as income rises. This isn't about scaring you, it's about planning. If you have control over which accounts you draw from, for example, Roth versus traditional IRA, taxable brokerage, or cash, the order and timing of withdrawals can affect whether you cross those thresholds. A bit of planning in the fall can prevent an unpleasant surprise in April. Let's get back to the heart of the question everyone asks: how do I move closer to those top monthly numbers? There's no trick, but there is a clear roadmap. Start with 35 years of earnings. If you have fewer than 35, the missing years are zeros in your average, and zeros are devastating. Working additional years, even part-time, can replace zeros and raise your benefit. Next, consider the quality of those 35 years. If you're currently earning more than you did in earlier decades, another year or two at today's higher pay can replace older low-earning years and lift your lifetime average. Finally, think carefully about timing. If you can afford to wait and your health outlook is solid, delaying past full retirement age increases your benefit by roughly 8% per year until age 70. After 70, there is no further growth. There's no reason to wait longer. But timing isn't just math, it's your life. If waiting means draining savings too fast, taking on debt, or losing sleep, the optimal spreadsheet answer might not be optimal for you. The best plan is the one you can live with. Here are two quick, real-world scenarios. Denise is 66 and turns 67, her full retirement age, in November. She expects to earn $30,000 by October through part-time consulting. Because she's in the year she reaches FRA, the higher earnings limit of $62,160 applies, and only her earnings before November would count against that limit. If she waits to file until her birthday month, she can avoid withholdings and lock in a slightly higher check for life. Now consider Harold, age 62, recently laid off with modest savings and a mortgage. For Harold, filing now can provide essential cash flow, protect his savings from being depleted at a bad time, and relieve stress. His check will be smaller permanently, but for his situation, stability may be worth more than the theoretical gain from waiting. Both decisions are rational because they fit the person, the budget, and the health outlook. If you're married or widowed, don't make claiming decisions alone. Spousal and survivor benefits can change the right answer. One common strategy is for the lower earner to file earlier to bring income into the household while the higher earner delays to 70, maximizing the survivor benefit that will continue for whoever lives longer. Think of it as quiet insurance. Growing the larger check helps the household for the rest of both lifetimes. If you're unsure, a short call with Social Security or a session with a knowledgeable advisor can clarify the options for your specific birth years and earnings histories. We also need to talk about overpayments because the letters do arrive and they cause panic. Sometimes Social Security later decides it paid you too much because of timing, a reporting lag, a work and earnings change, or a plain mistake. In the past, the default response could be harsh, withholding your entire check until the balance was repaid. After public pushback, the default in 2025 is far more humane. For Social Security retirement and disability benefits, the standard withholding is 50% of your monthly benefit. For SSI, it's 10%. And crucially, you have options. If the default creates hardship, you can request a lower withholding rate or set up a payment plan. In some situations, you can request a waiver if the overpayment wasn't your fault and repayment would be unfair. If you get one of these letters, breathe, read it slowly, and respond. Call and ask specifically about reduced withholding and waiver criteria. A calm conversation and a written request can turn a crisis into a manageable plan. Before we wrap up, let's look ahead. The official 2026 COLA, your January raise, will be announced in mid-October 2025 after the government releases third-quarter inflation data. Private forecasts right now hover around a 2.7% increase, but that's only an estimate and it can change with the numbers. Why does knowing this in advance matter? Because your budget for next year depends on it. If you know your benefit is likely to rise by a certain percentage, you can plan gifts, travel, medical costs, and withdrawals from savings with more confidence. So, what should you actually do this week? First, log into your My Social Security account. If you haven't created one, do it now. It takes a few minutes. Review your earnings record line by line to make sure each year looks right, especially the most recent ones. If something's missing, gather your W-2s or tax returns and request a correction. One fixed entry can raise your benefit forever. Second, look at your estimated benefits at 62, at full retirement age, and at 70. Seeing the dollar differences makes the decision more concrete. Third, if you're on Medicare and your income fell because you retired, lost a spouse, or divorced, download Form SSA-44 and complete it carefully. If you qualify, you can bring your premiums down for the rest of the year. Fourth, grab your calendar and mark the dates. Friday, August 29th for September's early SSI. Wednesday, September 3rd for those who started before May 1997 or receive both SSI and Social Security. Wednesday, September 10th for birthdays on the 1st through 10th. Wednesday, September 17th for birthdays 11th through 20th. And Wednesday, September 24th for birthdays 21st through 31st. Add the end-of-year double SSI deposits on October 31st and December 31st. Finally, circle October 1st, 2025 as your personal checkpoint. Review your claiming plan, verify your direct deposit, and confirm any work and earnings adjustments before the holiday season kicks into gear and the to-do list explodes. If you've stayed with me to this point, you now have an edge most retirees never get. You know the maximums, $4,018 at full retirement age and $5,108 at 70, and what they really mean. You know the average check sits around $1,976 in 2025 after the 2.5% COLA. You know the earnings limits, $23,400 before FRA and $62,160 in the year you reach FRA. And that the earnings test isn't necessarily permanent loss. You understand the wage cap of $176,100 and how a strong late career year can still replace a weaker year in your 35-year average. You've seen how Medicare premiums of $185 and IRMA thresholds can shrink a deposit, and how a simple SSA-44 appeal can reverse that when life changes. You've heard how up to 85% of benefits can be federally taxable once you cross combined income of $25,000 as a single or $32,000 as a couple, and that state rules vary. You know that overpayment rules have softened in 2025, with defaults of 50% withholding for Social Security and 10% for SSI, and that you can request relief if needed. Most of all, you've seen how real people, Robert, Sarah, and Maria, change their outcomes not with luck, but with information and action. Here's my challenge for you. Pick one small, concrete step before the day ends. Log in and verify your earnings record. Print SSA-44 if your income fell and your Medicare bill didn't. Put the September payment dates on your refrigerator and in your phone. If you're married, have a simple conversation about which check is likely to be the survivor benefit and whether it makes sense for the higher earner to delay. If you're still working, ask yourself whether one more quarter at today's pay could replace a weak year and lift your benefit for life. None of these steps is dramatic, but the impact over a decade can be huge. If this helped you, share it with one person you care about. That single text or email could prevent a missed payment, a needless surcharge, or a year of anxiety. Subscribe and turn on notifications so you'll see the official 2026 COLA announcement in October and our follow-up guide on how to adjust your budget for the new year. After decades of work, you've earned these benefits. Now make sure you keep every dollar you deserve, calmly, confidently, and on your terms.